Thanks for joining us today on Market the Call. I'm Morello Fernandez. Paul Harris with us on the show. He's portfolio manager at Harris Douglas Asset Management. And he'll take your questions today on North American and global stocks. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. And you can send an email to marketthecall@bnnbloomberg.ca. Paul, good to see you. Thanks for coming in.
My pleasure.
Okay, so we are near the end of the year.
Yes.
How would you characterize the trading year for 2025?
I think it's two words, maybe chaotic, but also I think that there was this kind of idea that the world is going to look very, very different starting in January till April. And all those things that people predicted, economists or whatever, really didn't happen. So I think that it was chaotic during that period of time, but also everybody felt that the world was going to go into a recession. They were going to have higher inflation. We were going to have slower economic growth. Really, specifically in the United States, none of those things really happened. And I think that was taking people back, and that filtered into higher stock prices, right? And I think one of the things that I kind of missed as well was the fact that the U.S. economy is so dynamic. We underestimate how dynamic it is, how dynamic the companies that, our U.S. companies are, that they were able to pivot very quickly when all these things were happening and still maintain margins, still grow earnings, and, not fight. Even though there was probably prices going up, they were able to manage that from a margin basis, either through using different suppliers or even putting pressure on suppliers to take some of the burden off the pricing. So it was fascinating. And, I think when you looked at COVID, a lot of companies were able to do that as well, but you just we had forgotten about that, and all of a sudden we felt that, this is going to be terrible. The chaotic part of it obviously was that you increased tariffs, you brought them down, you increased them, you brought them down. Depending on which country you were.
It was the backtracking that did almost as much damage half the time as the first announcement.
Yeah, so I think that really, and also I think the other thing was the bond market kind of put pressure on the administration to say, well, you can't do this. Like you better do some deals or bring down the tariffs or whatever. So that kind of helped a lot. So I think it is still very chaotic, but I think it was very chaotic, and it was unexpected, the kind of follow through and all this stuff, because people had a very, very different expectations about where the stock market would be, where the bond market would be, where the economy would be, and where earnings would be, and they were all wrong.
Okay.
Right?
Do you think 2026 will be as volatile a year?
I think so. I think the problem is with this administration, it is a very chaotic administration. There's no kind of, this is our economic policy.
Here's our plan, or we're following.
Right, our foreign policy, our economic policy, our domestic policy. There's none of that. It all seems to be very ad hoc, and one thing changes after another. I think that one of the things that are very important to look at is that, the United States thought they had lots of leverage against China. In fact, China had way more leverage against the United States. And so they were able to put a lot of pressure on the U.S. And I think that they are, I think that relationship has to be looked at in how do you deal with that from a foreign policy perspective? In my view, they've done a terrible job of it. But I think that that's one of the big aspects of it. You saw China continue to manufacture like crazy, like the manufacturing numbers are off the scale. And so I think that, that the leverage that they have with critical minerals is very important. And we're never going to be able to get to a level that China's able to do that with, because from a cost perspective and an environmental perspective, those kind of minerals are all over the place. There's lots of them around. It's just that the processing part, China really focused on that a great deal, right? And they focused on it because they also built out an EV business that uses a lot of that stuff.
So it's labor intensive.
Yeah. So to me, I think that that's the big thing. I really feel that you're probably going to see a lot of the issues with tariffs and a lot of the kind of chaotic policies that they have come to fruition in 2026, and we may have a much more difficult year. And so I think that's what you have to, from the stock market perspective, from the economic perspective, I think there are a lot of, like even the GDP numbers, if you really go through them quite, in detail, they were really not that great, right? And so, and the last thing is the Fed. I mean, here somebody comes out and says, well, if they don't agree with me, I'm not going to be happy. I mean, that's just not Like, that's a terrible thing to be saying to the economy, to the bond market, to the stock market. I think that these are, it may be good for the stock market because lower rates really help that, but I think the bond market will overreact in a very different way if the Fed is very politicized that way.
All right, and it could be by next year. We're going to take a quick break. Paul Harris, portfolio manager, Harris Douglas Asset Management. He's here taking your questions today on North American and global stocks. We're back in a moment. Welcome back to Market Call. We're going to start with an email right now from Jean, who says, what does the guest have to say about Telus? Our guest today is Paul Harris, and we can take a look at telecommunications, specifically Telus. People were a little confused about the dividend decision because, of course, BCE, parent company of this channel, cut its dividend, and they thought that Telus did that, and they didn't really. So if you can first explain their decision. And then what you see.
So a lot of these companies are based on, or they kind of talk about dividend growth, and they constantly increase their dividend on an ongoing basis. And so Telus is basically stopping that. They're just going to keep their dividend where they were. I kind of wish they cut their dividend simply because I think that would have been a better move. The stock had already fallen a lot. And so I think that's one of the things they probably would have been, from a board perspective, I think that would have been the best thing to have done, and maybe the stock would have fallen like BCE did initially, then bounces back. So I think that's one thing because they save a lot of capital and they could bring down debt. I think the environment for these companies has been very difficult. I sold BCE at the beginning of this year. I didn't sell Telus. But I think
so you've taken a hit on Telus.
Yes. So it's in our dividend portfolio, but I think that one of the issues is I think they face a difficult environment. One, there's a lot of capex to spend. I think the fruition of 5G is really not happened as quickly as I think people were thinking. And you have a CRTC in this country that is very kind of difficult to deal with, in my view, right? Because they constantly want us to have more players in the cell phone market. We're a small country. We don't need more players. I mean, the United States doesn't have that many players in the cell phone market. So I think it's this kind of idea that there's more competition. I think that it's better to maybe regulate those things in a better way, from pricing, et cetera. One of the things that Telus does have is that they've actually developed within Telus several other different businesses which have done well over periods of time, and they don't own a ton of media, which BCE does, right? So I think that there's some benefits to Telus. I think that from a board perspective, it would have been better if they actually really just cut their dividend and moved on.
Okay. Let's move on to our first phone call then. Chris is on the line. He's in Delta, BC. Hi, Chris.
Hi, Morella. I don't think I will speak to you beforehand, Merry Christmas.
Thank you.
Yeah, absolutely. Thank you for your hard work the whole year through. Paul, I would love to have your opinion on CN Rail. I think it's a stock you've liked in the past. I've been adding, it's in my top 5 positions at this sort of 5-ish year low. I'm wondering if you see value there too. I'm curious how much risk you see in the stock for, let's say, a 5+ year investment at this point moving forward. Thank you so much, and all the best to you both.
Chris, thank you for that. Happy holidays to you as well. CN, is this an opportunity to pick up where it's at today? Is it bounce back for 2026?
Yeah, I think so. I mean, I think one of the issues, I think one of the things, the bigger picture on the rail side is that the rail business is a very consolidated business. It used to be very all over the place. They own they were much more of a conglomerate. So they're much better at running their businesses, operate from an operating point of view. They don't hold any kind of other assets. So that's one thing. And they have better pricing because there's a few of them. They're not competing against each other constantly. So I think that's one thing. I think CN got hurt because of the tariff issue. But regardless, rail is way better than trucking. It's much more environmentally friendly. So I think that's one thing. I think that as we kind of go through the next year and a half, I think that CN and all these other rail companies will do better. Although, like I said earlier on, it's very chaotic. There are things that are changing slowly that we need to move things across our country, and that those things are into the United States. And I think that rail is certainly the best way to do it. So that's one thing. I think it'll help them out. The bad parts are all gone through. I think people feel that all the worst is through the rail business. So I think that's one thing. I think the other thing is that you probably get better pricing over the next little while. You can see that commodities and all these other things have moved up at higher pricing. So there's a real need for a lot of this stuff. So moving it across the country to the right spots are very important. So I think that'll help as well. So I think, I like the rail business because I think that it's a consolidated business. There's only a few players in North America. The one tougher thing for CN relative to CP bought Kansas City Rail, and CP has sort of a kind of North American, South American kind
footprint,
of much better footprint than CN. But I've owned it for a long time. I really think that the rail business is a great business to be in. And I think at these levels, I think you're getting it at a bargain.
Okay. That was for CN Rail, which has suffered this year. Let's go to our next caller, John, on the line in London with a question. Hi, John.
Hello, Paul. Thanks very much. The U.S. banks have had a great 8 months. Which do you prefer? Do you prefer the Trump darling J.P. Morgan, the strong brokerage banks, Goldman Sachs and Morgan Stanley, or the Citibank, which has lagged owing to management and other difficulties? Which do you prefer for 2026? Thanks very much, and Merry Christmas.
Thanks very much for the question. And is there a bank you prefer?
Yeah, so we own J.P. Morgan in our U.S. equity portfolio and Bank of America. Those are the two stocks I've talked about for a long time. With respect to Citi is probably the cheapest bank in the United States from a big money center bank. It's trading below book value still. It's a process of, a company that's going through a lot of changes, and I think that it's still, relatively cheap relative to J.P. Morgan, which trades at 2.5 times book almost, and Bank of America, which is at 1.89 times book. I think this, and I think the other play on banks is the regional banks in the United States, some of those smaller ones. And the reason why is that there's a lot of regulatory change going on in the United States over the next little while with banking. With respect to the Trump administration, they want to take away a lot of the regulations that came along with from 2008 with Dodd-Frank. And in some ways that may be a bad thing, but let's say they'd be able to take away some of the bad parts of that regulation. So that frees up a lot of opportunity for these banks from a capital perspective. So you could probably see them buy back more shares, increase their dividends, those sort of things, and give them more capital to expand into other businesses. I also think there's an opportunity for some of these banks on the regional side. You've seen a bunch of M&A on the regional side over the last year. That probably wouldn't have happened under the Biden administration. So you're seeing much more on the regional side. There are, we complain about having 5 banks in this country. They have 4,000 banks in the United States, right? It's ridiculous. So consolidating the banking industry there will be very good, I think, and that's going to happen for more and more. From a regional bank perspective, you can buy a regional bank index, I think, on the ETF. But I think those will do very well over the next little while. And I think this is regional banks used to trade at some like 3 times book value and some very higher multiples. And I think you may actually get to those high multiples in the next couple of years with these banks. Maybe not J.P. Morgan, which is already very high, or Bank of America. But I think you'll see these banks multiples expand because they're going to be able to do a lot more things and a lot more freedom on their balance sheet, but also a lot more freedom to buy institutions. And that may actually work in Bank of America's favor, which is some of them, Bank of America has never been able to buy anything. And so, this may be a chance that they're in an area where they feel they're not covered as much to be able to do that.
Right,
so they think a lot of opportunity there.
More M&A for next year. Okay, we're going to take another quick break. Paul Harris sticking around to take your questions today on North American and global stocks. Back in a moment. Welcome back to Market Call. Elliot's on the line. He's in Hamilton, Ontario. He's got a question today for Paul. Hi, Elliot.
Good afternoon. Please, barring a complete market meltdown, I think Netflix looks pretty interesting. I mean, if they walk away from the deal, the share price should go up. And even if they complete the deal, the uncertainty disappears and the share price should go up. Please, your thoughts on Netflix. Thank you.
Okay, thank you for the question. Netflix was gangbusters, right? In the middle of the year, it really has dominated streaming. And now it's got its hands in the pie for Warner Brothers. First of all, what do you think of the offer that's on the table?
I think that one of the issues with Warner Brothers had with Paramount. First of all, Paramount has to get bigger, so they really need this deal more than Netflix does. That's the first thing. And Paramount was that the deal was guaranteed by the family trust, but now they've taken that out and made it very clear that the family the father, Larry Ellison, will support the whole.
He's going to back it.
He backed the whole thing. So it becomes a difficult story now for how do you go back to the board for Paramount for Warner Brothers. With respect to Paramount, they need to do this deal. One of the issues that I have with Paramount buying it from a regulatory point of view, although they know Trump and all that stuff. The issue is that they're going to own CNN and they're going to own CBS News. Like that's really kind of an awkward thing to be able to say, and a lot more news stuff. So that's an awkward thing to put somebody in charge of all that kind of news and a liberal network and stuff like that. So that's one thing. Outside of that, in that, I don't know if there'll be regulatory issues with any of those things, but outside of that, I think for Netflix, what's really important is that this is the first time they've actually bought something. They've really been homegrown. They've grown everything themselves. I think it's all about the catalog, right? So if Netflix can get that, they will have a much better, broader catalog, deeper catalog yes. to do that. And so that's one really important thing for them, and that's where they spend a lot of their money on. And so I think that's really important. For Netflix, I think I think Hollywood doesn't like Netflix because they don't put stuff on to theaters very often. But Hollywood's been terrible about it. So they hated Netflix and kind of discarded it as something that was terrible. The reality is that the cinema business is going out of business very, very slowly, slow death. Streaming is where everything is at, and everybody wants to own that. So I think this is a good deal for Netflix if they can get it. It's not the multiple on Netflix is 28 times. This thing used to trade at 100 times before, so it's a lot cheaper. I think the caller's Elliot's right. If they walk away from the deal, the stock goes up. If they do the deal, I think in the long run it's going to be great for them. I think that, and they're not taking the CNN business; they're just taking the film business, right? So the studio business.
So would you dip in at this point?
Yeah, I think if you wanted to buy, if you like Netflix, I think this is a great time to be buying it, right? I think you don't lose too much by doing it to these levels. Unless they. The other issue is that they may up their bid even more, which would hurt the stock a little bit, I guess. But at some point in time, the board and the gentleman who runs Warner seems to like the Netflix issue, next bid rather, and it's their preference, I think, in the long run. So, Elson can go to the individual shareholders, but that's a hard thing to do. To get them to all vote in favor of the deal. So it's going to be interesting to see what happens and what Warner Brothers comes back with over the next couple of days.
Okay. All right, let's go to our next caller on the line. I'm sorry, is it Elliot as well or Jazz? Sorry, Jazz, what's your question, Jazz?
Hi, thanks for taking my call. My question is regarding Tesla, and it's twofold. I know it's hard to understand on this talk, and fundamental make no sense, and it's incredible forward price earning. So do you think the future business, the robo-taxi, and all that stuff is baked in this price? And how do you see future value for this, especially in 2026? And if I don't get a chance, thanks again for taking my call, and happy holidays. I'll hang up and listen to your comments.
Okay, thank you for the question, Jazz. Happy holidays to you as well. There's a lot to unpack with Tesla. We can't do all of it here, right. But I've heard people say the robotics for next year and the autonomous driving for next year is going to be big for this company.
One hopes. So I mean, I think that the robo-taxi business is a big thing that they've emphasized. I think so. The two things with Tesla is that one, I think that the issue with it is that they've not come out with a cheaper car. That's the bigger issue, right? They've come out, their cars are very expensive still. If you look at the Chinese maker BYD, they make a car that's excellent, probably way better than Tesla's in many ways, but it's certainly not available in this country because we have too much tariffs on it and stuff. So if you go to Europe, you see them all over the place. So that's one thing. They need to come out with a cheaper car. He's talked about it constantly.
They came up with a cheaper one. It was not that much cheaper.
Well, when I say cheaper, I mean something between 25 to 35 or something like that, and that's not 80 or 70 or something like that. So I think that's what I mean by comparable to a BYD.
Sure.
Right? So that's one thing. That's the first thing. So I think they need to come out with that as opposed to going and making a roadster and all these other things. That's one thing. And I think Tesla's been hurt because of that. I think Elon Musk, who is the father of the Tesla brand, effectively is spending more time in it, which I think that's why the stock is doing a little bit better here. It's done better over the last little while. With respect to robo-taxis and stuff like that, I mean, although they talk about it, in such a big way, they're way behind the curve relative to Waymo or on this whole thing, right? So Waymo is in so many different cities around the United States. They've got so much more data, and they've done a great job. And the funny part is, in Google's valuation, they don't value Waymo as much as robo-taxis is valued in Tesla. So I think Tesla's, they built a great car. By far, they are the best EV vehicle in North America. By far, like Ford and all these guys and GM are nowhere close,
sure.
And they make ugly cars. So that's like to me, that's one of the things about it. They're just ugly. So they make a beautiful car. They've got lots of data on the driving side. I think robo-taxis over the next year will make a big difference. I'm not sure it's going to make as much a difference as people think. And the robots working on all stuff, I think that's still well down the road. I mean,
so would you buy in at the level Tesla's in at today?
I mean, I wouldn't buy Tesla, right? I just think that margins are going to come down and stuff like that unless they change. They come out with even if they come out with a cheaper car, margins are going to come down. I think that I don't think that to me, it's an expensive car stock, and I think that you're better off buying other things, right?
Got it. Okay, we're going to take another quick break. We will look at Paul's past picks when we come back. Stay tuned for that. Time to have a look at Paul Harris's past picks. These are from February 24th of this year. At the time, Paul, he chose Alphabet, CEO Google on the NASDAQ at 181.19 and now at US 314.60. 74% upside, 74% a total return. Of the Mag 7, do you remember why you chose Alphabet, Google at the time?
Oh, so very simple. It was very simple. I mean, I think Alphabet was treated like it was, on a desert by itself, like it was trading at 18 times earnings. People were saying that they were not going to be in AI, that they were giving it, like I talked about Waymo, they gave zero value to Waymo and their other businesses like YouTube. So it was really trading at a very low valuation relative to the rest of those Mag 7. And I think what you've seen is that, one, they have come back on the AI side, and really with Gemini 3, people are saying that they're, it's almost equivalent to ChatGPT in their issues. Number two, they continue to see growth on the advertising. Everybody thought the advertising business would go away. Basically.
Because the search engine was going to go away, right?
So, but search is still important. And search, people forget about search. Like it's not so, if you're looking to do something more detailed thing, but if somebody's looking up something, a restaurant, they go to Google, right? They don't go to ChatGPT for that. So I think that's the other thing, that search will still be there. YouTube continues to do very, very well. Digital advertising continues to grow regardless of what people say. It's a huge business. I mean, there's nobody. Print advertising is slowly disappearing, right? Everybody does that. And if you want to market yourself, you still use kind of digital media. So I think that all those things are working in their favor. They have Waymo, which I think is going to be one of their big things over the next several years. So I think that, it was a very cheap stock when I did it, and everything else was trading in the mid to high 20s, and this thing was trading below the market multiple, actually, right? So I think that's the reason why, and they continue to grow very quickly still.
And I take it you've just held on to it.
Yes.
Okay. Let's get to your next past pick, which was Novo Nordisk, NVO on the New York Stock Exchange, getting a lift this week, of course, 90.59 US at the time, but to 52.93 today. So 41% drop, 40% total return drop. They are in now the obesity drug stream.
Yes.
And are getting a bit of a boost from that. Have you held on to Novo?
Yes. So one of the things I like about whether it's Lilly, we own Lilly as well, but both these companies, is that they're the only two producers of this drug, and people go on about new people coming in and stuff like that. That may be true, but most of them are at, they're not even they don't have a drug that's even coming to the market even, and they have to produce it and all these things. And these guys have moved on from injectables to, which why Novo's up in the last little while, is because their pill was approved. Mm-hmm. So I think one of the problems that Novo, when you think about these obesity drugs, most people think about Ozempic. They don't think about Zepbound. So they had a brand name,
yes,
but they kind of didn't use it effectively. I think more because they're a European company. They're just sort of, we don't do that kind of stuff, right? They didn't advertise as well. So they have a lead in the pill, but probably 4 to 6 months. They really need to grow, make sure that people are using their pill. And if they do, I think that'll be very beneficial to them before it really gets to the pill side. The issue with these drugs is that they drop weight, but there's about 100 million people that have obesity issues in the United States. Well, obesity causes type 2 diabetes, it causes heart disease, it causes stroke, it causes liver problems. These things solves a lot of things if you could bring down obesity levels to much lower levels in the United States and in Canada, actually. And so I think it'll save money from the insurance perspective, it'll save money at hospitals, it'll help people. So I think that's really important. I think it's worth buying here.
Okay, Novo Nordisk sitting there. Let's go to your past pick from February of MSCI Inc. on the New York Stock Exchange, and we don't seem to have that information. I've got it here, though. 573.55 U.S. at the time you picked it, to 581.96 now, so 1% return, 2% a total return. Do you remember why you dipped in for this?
Well, so I like this company. They produce about 200 different equity indexes around the world, for the world. People have to use them not only for benchmarking, but for risk management. They have a lot of risk management tools around their index, which everybody has to use. They've expanded into alternative asset classes, whether it be real estate and some other alternative asset classes on the benchmarking side. So they continue to do that very well. I think this is a company that has very high gross margins, very high operating margins. It's moved sideways for the last little while. I think that over the next year or two, you should probably see it do much better. But it's just a great business, right? It's not money managers have to use them, and you can't create your own index because that would be, you can't use your own index. So this is a great, and it's an oligopoly. There's only 3 players in the market: S&P 500, FTSE, and them, right? And they're the largest.
Okay, so let's take a quick break then. We will line up more phone calls and emails for Paul Harris. He's taking your questions today on North American and global stocks. We're back in a moment. Stay tuned. Welcome back, and thanks for joining us. Let's go to JP. He's on the line in Edmonton. He has a question today for Paul Harris. Hi, JP.
Hi, I had a question about Uber. I know you were just speaking about Waymo and robo-taxi earlier in the call. Just curious on your thoughts on how Uber fits into that ecosystem, and wanted to wish both of you happy holidays as well. I'll hang up and listen to your answer.
Thank you, JP. Happy holidays to you, too. Uber's an interesting one. I'm going to put this to you in a way of autonomous driving is coming. Uber's got all of this information that it holds on to with what it does. How will it be able to capitalize on autonomous driving? Is it going to pair with somebody?
Well, I think they've already paired with people, right? So I think that's one of their kind of ideas. I think they originally, when Uber was sort of all over the place and not run by the present gentleman who was CEO, it was doing all kinds of different things. So now they concentrate on Uber, the driving service, and Uber Eats. But they have worked with other people on it, and I don't think they're going to run their own business like that. They will work with other companies to offer that service. Uber's interesting, I think, because it's very clearly a business that was all over the place under the old CEO, and now it's really kind of very focused. They got rid of all areas that they weren't interested in, and they were really starting to generate a lot better rates of return. So I think it's a stock worth looking at. And so that's one thing. I think that it's really well run. They've cut a lot of costs out, and it's a legitimate company, where before it was kind of a crazy little company.
Ad hoc a little bit, yes.
Right. So I think that's one thing. That's why you want to own it. I think that, robo-taxis or whatever will certainly help Uber, right? I mean, it only helps them. They don't have to pay people, and they bring down their cost structure a lot more. I don't know if people have taken Waymo. It's pretty incredible. Like, it's just,
I have not, no.
Right. So, my daughter took it when she was in San Francisco. You just get in and, and you can hook up your thing. So I think this whole idea of robo-taxis is going to be very beneficial. And I think that they're much safer than even getting an Uber driver, and simply because you don't know if that Uber driver's broken up with their girlfriend or what, right?
Sure, but I still don't trust the robotics that much to get me there. We had one of our crew members just say, John said he loves it. Yeah, others love it.
Yeah, I mean, young people don't care but it's.
I have trust issues.
Yeah, so well, I think you should have bigger trust issues with somebody driving you around that you don't know who's in the car, right? But whereas this thing just sort of takes you and drops you off, it's actually even cheaper than Uber in some places. So I do think that's going to be a big, huge benefit. And Uber Eats seems to be actually doing very, very well as well for them, especially if you look around Toronto. But I think that's really the two businesses that they've really concentrated on, and they're running them very successfully. So I think Uber has it's a good opportunity, especially with the present CEO, to drive better margins and better rates of return for their shareholders. And I think it's a good time to buy it here.
Okay, let's go to David on the line in Toronto with a question. Hi, David.
Hello, good afternoon to you. And let me first wish you a happy holidays and all the best for the coming new year. For the gentleman, I have a question, please. And of course, excellent job that you're doing. I don't forget that. For the gentleman, I'd like to ask about Celestica. If he has it in his portfolio, and second, why should I hold it? Why should I hold it? Give me some kind of feedback. Why should I hold it for the next 2-3 years? Thank you very, very much, and happy holidays again.
Thank you very much. Happy holidays to you. Celestica, where do you stand?
So we don't own it. Celestica has been a very weird company because over the previous years it was just a terrible investment, right? And it just did nothing for years and years and years. And I think just as kind of this ChatGPT came out and Celestica really benefit from a lot of what was perceived as AI growth, and they've done really well with all those sort of things. I think it's a very expensive stock at these levels. I wouldn't buy it here. I think it is a manufacturing company, and so trading at the multiples it has, I think it's too expensive. I think you will probably see, get a pullback. Especially if we have a hiccup along with this AI stuff over the next little while, and I don't think you want to own it presently. So I would certainly not buy it here. I think you're better off in other areas.
Okay, that was for David. Let's go to Patrick on the line. He's in Calgary today. Hi, Patrick.
Hello, Merry Christmas. My question is on Cameco. Recently, Cameco has had a significant run-up with the announcements of multiple billions of dollars in infrastructure spend in the United States. And just wondering if Paul thinks that Cameco is still a good stock to play the outside in the uranium market.
Okay, thank you for the question. Cameco has had a run-up this year, of course. And a lot of people are talking nuclear build-out.
Yeah. So it's not a company I own, but I think Cameco has got perhaps by far the largest uranium deposit in the world, I think. And so and it's easy to access, et cetera. So it's. So I think that's the thing that's very important about that asset. So it's a great asset. And so that's one thing. I think that this idea that nuclear is coming back around the world is really going to help Cameco over the next little while. I think the stock's run up a lot in anticipation of that. So I think you probably get a pullback on the stock. But I do think that it's nuclear is become something that people are really thinking about, where we weren't thinking about that. Somebody kind of recommissioning 3 Mile Island, that would. You would never thought about that even, especially if you grew up understanding what happened there. So I think that nuclear is becoming a very important part, and smaller nuclear. I think that's the other issue that people have talked about, is that you don't have to have a huge, massive nuclear plant. You can build it on a smaller scale, and there's a lot of startup companies doing that. So I think that's going to help Cameco over the next little while. And I think Cameco is, tied into a lot of this stuff. They've actually worked together with a lot of places to make sure that these things are going to work out over the long term. So I think Cameco is a good story. I just think it's run up a lot with a lot of anticipation. And so I think you'll get a pullback in the stock. And if you do that, I think it may be worthwhile buying it then.
Okay. That was for Patrick. Let's take a quick break. We'll be back with more of your phone calls in just a moment. Stay tuned. Welcome back. Let's go to Michael. He's on the line. He's in Miami today. Hi, Michael.
Yeah, good afternoon. I would just like to know about the pharmaceutical in general, and mainly Pfizer, or if any other stock are better than Pfizer for the pharma.
Okay, thank you for the question. Thanks, Michael. We talked about Novo earlier. Right. Let's take a look at Pfizer. Did you say you own Pfizer?
We don't own Pfizer. I mean, Pfizer's not an expensive stock. It's trading at 9 times earnings. It's got a 6% dividend yield. I think the trouble with we own Lilly and we own Novo, so I think that's my preference would be Lilly because I think of the kind of blockbuster drugs that they have, and Novo. But I think the problem for Pfizer is that, and as it is for many of these pharmaceutical companies, they've really had, and healthcare has been very terrible over the last little while. But as a general rule, I think they've when people think of cancer drugs or some of that, cancer is kind of an big umbrella. Like there's specific kind of cancer drugs, right? So that's one thing. So you may have a cancer drug that is not going to be a blockbuster, but works for certain kinds of cancers. So the issue, what I found out is that when I looked at these things, is that most drugs that make you the most amount of money in pharma are social drugs, the drugs that are not really solve your problem, but are just, whether it's Prozac or even these weight loss drugs and stuff, that you have to take them forever, and so you're not not solving the problem in many ways. So I don't think there's anything in Pfizer's backlog that are going to be able to do that for them. I think you're better off owning these drugs that have from a perspective of over the next several years, have these drugs that are going to generate lots of returns for them. They have some interesting drugs in there coming out, but they're still going through a lot of trials and stuff like that. So I think it's better off owning something that is going to be making you lots of money over the next little while, as opposed to and wait around till Pfizer comes out with something that's, I would say, a blockbuster and then go from there. So I think that's the trouble with the pharmaceutical industry. They got a very high multiple because people thought they were growth companies, but because they had these big blockbuster drugs, and that's why they thought they were growth companies. But they are actually not as growthy as people think.
Okay, let's move to our next caller. Then we have Paul on the line in Orangeville, Ontario. Hi, Paul.
Yes, AYA silver and gold. Given the factor of silver to gold being still too low, and does he agree they should go to 25? What does he think about AYA and the factor of silver to gold?
Okay, so AYA gold and silver at 1971, a little bit down on the day. Gold, of course, the price of gold going through, and silver going to all-time highs as well. AYA gold and silver, the highest it's been is 2097 earlier this month.
Right.
So what are your thoughts on AYA gold and silver?
So we don't own any gold stocks. So I think from my perspective is gold's had this incredible run, and silver's catching up or done much better than gold actually over the last little while. So I don't, I think that if you want to play gold or silver, you can buy the commodity very easily through an ETF, and I think that's the way I would look at it. I don't like to buy companies because I think they're just much more difficult. A lot of gold companies are in very difficult parts of the world. Their operations are much more complicated than people think. And so I think that's one of the reasons why I stay away from them. Plus you're betting on a commodity, and this commodity's, it's really run up a lot. So it may actually go up a fair bit more because of the US dollar and other aspects of what's happening in the US. But I think that it's run up a lot. I think the gold is due for a reasonable pullback. And then I would look to buy gold stocks if I wanted to. I don't think about buying gold stocks or gold, but I think that if you were, I think you'd wait for a pullback in gold to be able to buy some of these companies.
Okay, we don't know when that pullback's going to come. Let's get to an email here from Andrew. He says, please provide your outlook for WCP for the next 12 months. Let's pull up a line chart and take a look at where we are. Initial thoughts?
Yeah, so Whitecap is a very interesting story. I think they're a company that has some great assets. They really care about shareholder value, where you look at, they buy back shares, they've increased their dividend, so they care about being shareholders. They've got some, because of they've looked at, as many oil companies think about, if I increase production, what do I get out of that relative to buying back my shares and all these other things, paying down debt. So I think this company's done a great job of that. I think the trouble is that oil and gas have been very difficult environments over the last little while. But we own C&Q and we own Suncor, and I think in an environment where you're worried about what happens to oil, owning these bigger companies, stabilizes you a little bit. You may not get the upside as much, but you also don't get the downside as much. And so, but I think Whitecap has done a very good job, good management, good quality assets, continue to grow their production, but also thinks about shareholder value from an oil perspective, which many years ago, they didn't care about shareholder value at all. So all they cared about is constantly increasing production and doing it at very bad levels. So I think that these companies are actually well run. Think about their business, think about return on invested capital a lot more. And I think that's why you want to own some of these other companies like this. Whitecap's a good company like that.
Okay. Let's take another quick break. When we come back, we'll have a new top picks from Paul. That's next. And join us on Monday for Market Call. Brianne Gardner will be on the show. She's Senior Wealth Manager from Velocity Investment Partners, Raymond James. She'll take your questions on Canadian and U.S. large caps. That's Monday. Time now for a new top picks from Paul Harris. We're going to start with First Service Corp, FSV, on the TSX. They do property management, among other things.
Yes, so they do property management, a lot of it in the United States, and they also do services businesses, so California Closets, people may know that name. Paul Davis is another one that they own. So what I've liked about this company is a couple of things. One, they grow organically, and they also they grow by growth by acquisition. So they buy these small tuck-in acquisitions, either on the service side or on the real estate side. The other thing I like about them is that although they're quite large in this business, it's still a very fragmented business over the year, and so there's a lot of opportunity to buy smaller businesses on an ongoing basis. And on the M&A side, they've been very, very strict in sticking to their requirements on the M&A side, which is very important, I think, when you're doing a growth by acquisition story. The last thing is that on the property management side, there's sort of, you don't get a property manager and then get rid of the next. You may get rid of them the next year, but usually they stick around for a few years. So there's an annuity to it, and there's an inflation indexing on that side as well. So I think that's really great. The stock has never been cheap, but it's a great time to buy it when it falls like this. I think there's a great opportunity to buy this company. It's incredibly well run. Jay Hennick started this company by cleaning pools when he was a university student, or maybe just before a university student. He turned it into this great business. So I think it's a fantastic Canadian company, and you get a great U.S. play because they're very large in the United States.
Okay, so that was for First Service Core. Let's get to your next pick. Visa, just V, on the New York Stock Exchange. Visa's been coming off quite a bit. We've had a number of calls about what's going on with shares here. They're at $355.07 today. What do you like about Visa moving forward?
Well, so Visa is like a toll booth, right? So every time you use a Visa card, they get paid. I mean, that number's gone down over the years, and so there's been some issues with it and all stuff. But that's exactly what it is. They don't take on any credit risk. The bank takes on the credit risk when you use a Visa or a MasterCard. There are only two people. Their network is incredible. They put through 64,000 transactions a second. There's also a ton of people that still just use cash, and I think that around the world, especially in Asia, so there's good opportunities to grow. The other thing that Visa, which was they're strong, but they're becoming bigger and bigger in, is the B2B businesses, because a lot more businesses can use their credit card to pay for professional services like lawyers and accountants and all that stuff. So there's great growth in that business. I think one of the issues they've had is that, like with stablecoin and all these other things, they are, people think that their network or their, the value propositions they give will go away. But they're involved in all these things from the technology side. It's not something that, I didn't hear about it. You know what I mean? They are involved. They are making a lot of money, technology spend. It has 80% gross margins, incredible operating margins. It's a great business. There's good secular growth on this business as well. So we really like it, and we've owned it for a long time, and I think it'll do well if you buy it here.
Okay, that was for Visa. Let's go to Adobe, which is ADBE on the NASDAQ. The conversation around Adobe has been the same, right? What do you do with the creative services that it offers to its clients? It's tried to going to more subscription service, I guess.
Yes.
But will its main business model be eaten by AI?
Right, so I think that's why Wall Street doesn't like it. And I think part of the problem was Adobe emphasized the AI part of their business way too much and said, we're going to get. So I think they overhyped it, and it hurt them a lot. And I think that's why the stock has come off. But this is a company that's grown its revenue. From in 2020, it had $3.4 billion in revenue. Today, it has $6 billion in revenue. It's grown its top line by about 10%. It's bought back 10% of its shares. If you're growing your top line, buying back your shares, you're just compounding it at an incredible rate. I think that hype about what they're going to be able to do with AI is, people have kind of are already saying that they're going to disappear, like Google was going to disappear, and that's not going to happen. I think there's a great opportunity for them in AI with a lot of the creative products that they offer. But I think it'll take some time, like everything. People have to learn to use it, et cetera. And I think that's one of the things. But I think at these levels, you're buying it at 14 times earnings. It's rarely traded at these levels at all. So you're getting a really cheap stock that continues to grow its earnings by 10 to 12% and buys back its shares. I think it's a compounding machine. Right?
How is it employing AI in its business model?
So, I think what the issue for them is that, the problem is that although there's a lot of AI internally inside their business. So, for example, if you have a Adobe, if you print out you have an Adobe printout, years ago you could do nothing with that. So let's say you had a bunch of numbers on it. You could use their AI to say, add it all up. Or in my case, for example, when I get a printout for an Adobe of a client's account, I can ask them, oh, what is the capital gains on the Adobe sheet? And it'll give you those numbers. Or if I had to sell, I have to create $100,000 worth of, cash. You can do that from the Adobe sheet using AI. So there's a lot of internal products you can use with the Adobe, but I think that they overemphasize what you can do with it, and that's really hurt them. And I think now it's all in the stock already. You're getting it really cheap, and I think that they're slow. And the other part was that they wanted to do this big acquisition I can't think of the name of the company that they were, FEMA, which came public, I guess. So they wanted to buy that, and then it was kiboshed by the administration, saying that if they did it this year, they would have been able to do that. But I think that that's kind of hurt them a little bit. But I think that, it's a great business. Everybody uses it still. I think that more and more people will use the AI. I mean, that's what I use on it. But I mean, other people use other things from a creative perspective on it. And I think so, you're not buying it at an expensive rate.
Okay, so now would be the time to pick it up if it's a stock you are interested in.
Yeah.
Okay. Paul Harris, that is where we have to leave it. Thanks very much. Happy holidays to you.
You too. Thank you very much.
And thank you for joining us today on Market Call. Hope you have a good holiday season. We'll be back here on Monday. Have a good one.